Hi, everybody, and welcome to Ask a Pro. This is going to be really exciting webinar, podcast, however you're listening or viewing this. I'm really excited to have with me Jeremy Knott with the Golden Age Financial, and we're going to be talking about reverse mortgages for financing the construction of an accessory dwelling unit. So I want to welcome Jeremy. He's getting settled in. We're going to be here for a while, just in case, you guys get rocking and rolling with the questions. We've set aside quite a bit of time, so we're going to make sure to kind of answer all of them as we can. So my name is David Donahue. I am the host of Ask a Pro, and I am excited to have Jeremy with us. Some of our best practices that for those of you who are joining us live, if you can be sure to put your questions or comments in the chat or the Q&A, I'll be able to see either one of those. And during the presentation, because Jeremy has one he's going to be sharing with us here shortly, we'll then be able to kind of have a live back and forth. That is, if I don't dominate the questions, because I have a lot of them. Welcome, Jeremy. Thank you for being here today.
Thank you for having me, David. I appreciate you being on the show.
No, this is fantastic. Hey, you and I had a really good first meeting because I didn't really understand reverse mortgages and how they can really be of a tool or a benefit to somebody who's looking for, to build an accessory dwelling unit. Because face it, a lot of people who may want one can't afford it. And those people, and they may not have the income to qualify. And those folks might be a little bit older, sitting on a lot of equity, sitting on some land that they could construct one, but they just don't know how to do it. And you really led me down and this road. You were very patient with me, asking a lot of direct questions, and I appreciate that. But I'm just going to turn it over to you because this is such a fascinating topic, and I think something that people should really understand the advantages and the disadvantages.
Absolutely. And I appreciate you starting out like that. We did have a great conversation. And for those watching at home, David asked me a level of detail that 99.9% of my clients will never, ever touch on. He's so thorough, and I really appreciated that. And so hopefully we can get at least close to that level for some of you more detail-oriented folks. One of the things that I do want to touch on before I dive into my presentation is exactly what you said. Some people can't afford it. So this is really a tool that once you understand how to plan with it, it opens up a world of possibilities, not just for ADUs, but for long-term planning, like long-term care, in-home care, really funding your retirement, trying to have fun with your life, because let's face it, that's the real American dream, is to be able to do stuff while you're retired. And so people have to face what's called an economic reality, though, when they get there, is can I afford this, yes or no? And they might not be able to afford a $400,000 ADU, but they might afford a garage conversion, and that can still give them $1,500, $2,000, $2,500 in cash flow. So we'll dive into more of that in just a little bit. So that being said, is it possible to share my screen?
Yes.
All right, let's see. Share screen. All right, everyone see that?
I don't see it on my end, so let me make sure. And share settings. Let's see, one panelist can share at a time. Let's do this. Host and panelist. Try it again.
Try resharing. All right, you seen it now?
I am not. So let's see. Okay, we're having a little bit of a technical issue here. Bear with us, folks, as we get into this. I'm just checking the share screen. I have one participant can share at a time. Advanced options, host and panelist. Dual monitor. So yeah, I have all of that. Let's say view, gallery, speaker. Oh, speaker, gallery, speaker. Yeah. I don't see it up, but try it if you want to. Just see if you can.
Let's try that.
Now we have it.
There it is. Okay, so now let's do this. Let's see if we can swap the here we go. We'll just go like this. How about that? Do we get it? And I lost your mic.
Thank you. I was
There you
moving
go.
my mic around and I hit the mute button. Okay, I think we're done with those technical glitches. We're up and
Perfect.
running, and Jeremy is sharing his slideshow with us. So for those of you who are listening to this in a podcast, just feel free to kind of reach out to me or to Jeremy, and we'll be sure to try to share this with you. So even though you can't see it, don't worry. We're going to make sure that we get it in front of you.
Okay. So this is what I call the senior's guide to using a HECM loan to finance your new ADU. So what I want to do is I want to dive into the deep, scary end of this thing first, because it was one of David's most specific questions and concerns. So first and foremost, we want to figure out, are these loans predatory, right? There's so much misinformation out there about these loans, and they come from either when these loans first originated, and they're 60 years old at this point in the United States. They've been around for a really long time. And so once HUD decided to take over the reins for these things, they created a set of guidelines that lenders have to play by in order to be able to offer these loans. And I don't know if you guys know this or not, but the senior class is the most protected class of any class in the United States. So they have the deepest pockets, they have the most lobbying power, they have the biggest group as far as the baby boomers are concerned. When they move, markets move, and when they move, laws move. And so these laws are really designed around these programs to protect seniors in these programs. Gone are the days where the bank owns your house or the bank changes your house. It just doesn't exist. One of the ways that it was put was, does the reverse mortgage rob your equity? So what I wanted to do is just kind of a 30,000 foot view comparison of what a conventional loan looks like versus a reverse mortgage. So everybody knows that with a conventional loan, you have a mandatory monthly payment. So with a monthly payment, that reduces your cash flow. When you're a senior and you're on fixed income, there's no way you can go work more overtime. There's really only one thing you can do, and that's cut your expenses. And so if you have a mortgage payment, you can't just cut that mortgage payment or reduce it if you have something come up. So this payment is required regardless of any unexpected expenses. One of the biggest ones that seniors face is a loss of a spouse. So when that spouse passes, they lose that spouse's income. So if you're relying on 2 Social Security checks and a spouse passes, you lose that Social Security income. That's catastrophic if you're making a mortgage payment. The other thing about a conventional loan is you're paying nearly all of that interest in the first 15 years of a 30-year loan. So you end up paying about 12 to 15% of the actual balance down in the first 15 years. So really you're writing a check and the balance isn't going anywhere, but almost staying flat. The other thing about a conventional loan is that if your value drops, let's say it was 2008 or 9, that repeat, no matter what happens, you lose that equity regardless of what type of loan that you have. You could have a first mortgage, you could have a first and second mortgage, you could have a reverse mortgage. It doesn't matter. If the home equity, if the value drops, the home equity disappears. Now, the important distinction between the conventional loan and the reverse mortgage is this. With a conventional loan, upon your death, the full amount of the loan needs to be satisfied by the estate before the heirs get to inherit a nickel. And that's regardless of the value of the home. So my background, I've been doing loans for over 22 years now. So I was in the midst of it when the crash happened. And so we were watching folks that had a mortgage for $500,000 suddenly have a home value of $300,000, and they were $200,000 upside down. They couldn't just walk away, because if they walked away, the lender would just send them a 1099 for that 200 grand, and now they've got an IRS bill. So people were doing short sales. A lot of people just set the keys on the counter and walked away, but that doesn't mean that the loan is satisfied. The home goes through the foreclosure process. Whatever that sells for, they just say, okay, if it's 500 minus 300 at the sheriff's sale, you still owe me 200 grand, and they're going to come get it. And they might show up on your credit report as a discharged debt, but discharge does not mean that it's gone. It just means that they discharged it on their books and wrote it off as a loss, but that debt's still going to follow you around. So if we look deeper into it, there's a lot of stuff that this loan has as far as a benefit, right? It gets you into a house that you can't just write a check for, but there's no protection for the consumer. if the values drop, or if they have income issues, or they have a loss of income, they're required to pay that payment. So let's look at a reverse mortgage. So upon death, to keep the home, what the heirs do is pay either the loan balance or 95% of the current market value, whichever is less, or they can just sell the house outright and keep the difference in equity. So if there is a spousal team and one of the spouses predeceases the other spouse, the remaining spouse can stay in the home. Nothing changes. They just stay right there. They don't have to make a mortgage payment. They don't have to do anything, which in that case, if you have someone with living on 2 Social Security checks and one of them goes away because of a death, their life doesn't change other than the fact that they just lost their loved one, which is obviously a huge deal. And I couldn't imagine having to deal with having to sell and move and leave my house because I couldn't make a payment after losing my spouse of 20 or 30 or 50 years. So that's a really important distinction. So what I mean by 95% of the current market value. So let's say you've got that scenario. You've got a loan that's $500,000 and all of a sudden the house is worth $300,000. And then the last person on the loan passes away. The heirs can still inherit that house. It's technically still theirs to inherit. It's not the bank's. It doesn't become the bank's. Instead, what the heirs can do is they can go get an appraisal. And then at that appraisal value, they would pay off 95% of that day's market value. And that's a really important thing to understand, especially in a California market, because let's face it, if we have another catastrophic real estate drop, it's only going to take 5 to 7 years and that house is going to be right back where it was. And so if you can get a loan to pay off that 95% or use life insurance to pay off that 95% of that value, the house is yours. Now, here's the other neat distinction with that is because it's non-recourse, that means they can never owe more on the house than its current market value because there's FHA mortgage insurance. So what that means is the heirs could do that. They could go get an appraisal and say, hey, you know what? The house is worth 200 grand today. I know in 6 years, it'll be worth 500 grand again. We're going to make this happen. Or they could just say, you know what? I live in New Jersey. I don't want to deal with this. I'm literally going to set the keys on the countertop and walk away from it. The lender will go through the foreclosure process on the home. But because the home is in either the name of the parents or the trust, and it's a non-recourse loan, they're going to foreclose on it and they're going to sell it at an auction. And then it just goes away because the mortgage insurance makes the investor whole. And so there's nothing to come after anyone for. And so that's a really, really important distinction. Question.
Yeah, one, as you're diving into these technical things, and I think this is really good for everybody to be aware of, is one, Jeremy is a professional. He's good at being able to explain this, but there's also, like he said, the seniors are a very protected class. There are HUD counselors that if you're thinking about doing a reverse mortgage, there are people that are working for nonprofits and other sort of government entities that you can talk to. So, if you're trying to say, hey, I want to understand this and I need some information, there are resources out there, that can help you, educate you. Next is, Jeremy, so the 90%, 95% of the current market value, or or whatever is less, will you in your presentation have a sort of like let's take an example of what you're just giving, like if, let's say somebody's 60 years old or 62 or 65, they get a reverse mortgage, they take all this money out, they live until they're like 90, and they've taken out all of this money. And will you be talking about, would they be able to take out more than what the house is worth or it's appraised at, or does that reverse mortgage stop once they've maxed it out?
No, I will be touching on that more later. And there's actually 2 parts to that. I am going to circle back. So just so everyone is aware, that's a mandatory proposal stage. Before you do anything next, you have to do a HUD counseling session with an independent third-party counseling company. And so we're required to provide a specific set of documents that we do. And we go through them with you because, in my opinion, it's very important for you to understand that prior to even getting on the phone with the HUD counselor, so that when you actually get on the phone with the HUD counselor, it's more filling in any gaps that maybe we missed or maybe questions, after getting off the phone with us, so that you can get these questions answered. And then again, because it's an independent third party, they don't have any ties to this loan or you. So they're going to, they don't pull any punches and they're not trying to sell anything. Their job isn't to get you a loan or get you an ADU. Their job is to just review the documentation and understand what a reverse mortgage is. And so
And I didn't know that. I mean, Jeremy, I had no idea that that was actually some part of your procedures, or maybe it's just a banking procedure for reverse mortgages. But I think that that's a wonderful kind of sort of safety net to kind of not only to the person who's trying to understand this, but also to their family.
Oh, absolutely. In fact, so the way the HUD counseling works is kind of unique. So the homeowner or the borrower has to be able to do the counseling themselves. However, other people can be present. So we've had adult children present. I've had concerned neighbors just say, hey, I want to just sit and listen. I want to be a fly on the wall. I have one client who's she's been divorced for like 20 years, but she still talks to her ex-husband on almost a weekly basis because he's a really smart guy. And as far as finances are concerned, he's a wizard, and he is her go-to for all of her financial questions. So he wanted to sit down with it. And at the end of it, he's like, well, wow, after my presentation and that presentation, I think this just makes sense for her.
Oh, that's great.
Yeah, it's really an amazing tool. And I mean, we've involved financial advisors in the process. Like I said, adult children are very common to sit at the table while mom and or dad does the counseling on the phone. So yeah, it's a fantastic tool, and it really does put a lot of people's mind at ease knowing that it's a third party that has nothing to do with either of us. So the last thing I wanted to touch on with the reverse mortgage, and this is a critical item. So there's no monthly payment ever. So people go, how's that possible? That sounds too good to be true. The way a reverse mortgage works, right? Everyone understands how a conventional loan works. You get out a loan, you got a 30-year term, you make a payment, it's principal and interest. And then over those 30 years, you pay the loan down. We already brought up, you pay 12 to 15% of the balance in the first 15 years, which amounts to virtually nothing on a loan. So with a reverse mortgage, there is no set payback schedule, which means several things. One, there's no monthly payment required. You can make a payment if you want to. In fact, you can pay as much or as little as you want, but you do not ever have to make a payment if you don't want to. That's part of the strategy that I teach. If you're a senior on fixed income, that's going to increase your cash flow. That also provides heir and spousal protection, because if for some reason you're making a mortgage payment, you have 2 Social Security checks, and then you lose one because of a death of a spouse, you don't ever have to worry about stroking that check for the mortgage. Now,
Yeah, we're getting a couple glitches in the your
if
camera
you're
feed,
concerned about the
Jeremy.
balance growing, then you simply write a check for the interest every month, and the loan balance doesn't. Yeah.
Yeah, it was
better?
just a little bit of a glitch in the camera feed, so you glitched out there just for like 3 seconds.
Got it. Okay, well, let me back up just a little bit then. So with a reverse mortgage, instead of writing a check for the interest every month, what happens is the interest that you don't pay accrues onto the principal balance of the loan. So the loan reverses or grows over time. So this is where that concern of, does this thing rob my equity? The difference is the loan balance grows by what the rate is, but the home appreciates by whatever the value is. So the way these loan programs are designed is because of the FHA mortgage insurance, they try to design them so that there should always be equity remaining in the property for either them to sell the house later on if they want to move, or the heirs to inherit. So can it happen where the equity values can make it so there's a delta where there is no equity? Absolutely. But that's right back to the conventional loan, where you can have a loan balance and property values fall, and there's that delta where you owe more on the house than it's worth. Again, the difference with the conventional is you have to satisfy that balance. If you're senior going, hey, I want to go move into a retirement home, and you owe more on the house than it's worth, and you're in a conventional loan, you can't walk away. You have to pay that off in order to satisfy that lien. In a reverse mortgage, they could literally just walk away from the house and go move into a retirement home, and there's nothing anyone can do about it. That's why they pay that FHA mortgage insurance. It's amazing.
And is there a chance in that example where would the guidelines ever allow for a homeowner to have taken out more than what the home's worth?
Yeah. So when I show you the way the line of credit gets structured, that is another amazing part of this tool. And if it's okay with you, I'll circle back to that, and we'll elaborate more on that when I get to the line of credit example. Okay. So when you really compare apples to apples on this thing, one way or another, you're going to pay to live in your home, and you're going to pay for your own lifestyle. So with a conventional loan, you're going to have that mandatory payment, which reduces your cash flow. 90% of your payment's interest, and the money is due every month, or you're going to face foreclosure. So I'm sure everyone could probably, right off the top of their head, in 2 seconds, name someone that either lost their home or about lost their home in 2007, 8, or 9. I know lots of them because I've been doing this job for so long. With the reverse mortgage, there's no payment. It increases your cash flow. the home appreciates, which pays for your retirement ultimately, and then it provides security for you and your heirs, and it's backed up by FHA mortgage insurance. And so when I look at this, the real question is not, is this predatory? It's which one is the more dangerous of the two for a senior living on fixed income? And in my opinion, even though I sell these things, the conventional loan is the more unstable program for a senior citizen, especially when you want to do things like build an ADU. So what I want to do is I want to break down a couple of the different options for paying for ADUs, just as a comparative analysis, right? And then we can kind of dive into some of the pros and cons of each of them. So if you have anything that pops out at you, David, please ask, okay?
Will do.
So the first one is cash, right? I know lots of people that could write a check, but I know way more that couldn't. But the thing is, the cash, that's your nest egg. And it takes a really, really long time to build up big chunks of cash when you're on a salary or even commission, saving. It's a lot of sacrifice. It takes a really long time to get that big chunk, but that big chunk gives you buying power. But at the same time, once you spend it, you eliminate your safety net, and then you have what's called an opportunity cost. You lose it. So what if you spent that to build an ADU, and then all of a sudden you had the opportunity to buy, I don't know, that dream muscle car you always wanted, or that boat you always wanted, or suddenly your ability to go on vacation all of a sudden just changes because now you have no more mortgage payment. Or, I've had clients buy RVs and go drive around the whole entire country because that was their dream. So you lose that opportunity later if you spend all your cash now. And I'm not saying it's the wrong thing to do. That might be the perfect solution for you. But at the same time, once you spend it, it's gone. And if you buy a depreciating asset, you're not going to replace that full amount of that cash back. So having it in the bank allows you a lot of leverage because you can take loans out and say, hey, I have assets. But once you spend the asset, it's gone. The next one I always get asked is the HELOC. Hey, I want to use a HELOC. So when a senior is building an ADU, I think in terms of long-term stability to be able to get the loan done. Because let's face it, these projects are really fast ones are 12 months. Average is about 14 to 18 months. Correct, David?
Correct.
Okay. So with a HELOC, the traditional ones, there's a set amount that's borrowed. There's no increasing it without going in and refinancing it again, paying the costs again. The other thing is the lender can reduce or revoke the available credit line at any time, whether there's a market downturn, you have too much debt on your credit report. They pull soft pulls all the time on credit and they analyze your debt to income ratios and they go, this looks like it's going sideways. We're just going to reduce it down to whatever they're owed. Or if there's just general turmoil. So when COVID started in March of 2020, the big four banks that were doing HELOCs all stopped doing them. And the people that had HELOCs available to them, many of them had them reduced down to whatever they owed or turned off entirely. Some of them didn't get there, but the ones that I found that didn't were like 780 to 800 plus FICO scores, no other debt on their credit. I mean, these things were just, there were people that so didn't need money at all. And so if you think in terms of building an ADU and then suddenly having something like that turned off, I mean, we literally had clients that were in the middle of building ADUs that had HELOCs, and that's how we got their loan because the HELOC got turned off. So they needed money to finish the project. So with a HECM loan, we structure these different ways, but the main one we do is a HECM line of credit. So it functions exactly like a traditional line, except for these key differences. One, the unused portion of the line actually grows over time. So that means if you take this thing out and just let it sit, you're going to have more money available to you later on, regardless of several things. That's regardless of the value of your home. And that's regardless of the value of your home. And that's regardless of whether you use it or not. So I have some people say, you know what, I don't want this thing. I don't need this thing. Perfect. You take it out today and let it grow for 5, 10, 15, 20 years. I don't have a crystal ball. I don't know what my health is going to be like in 10 years or 15 years or 20 years. But I can tell you this, the older we get, the more our bodies break down. That is a guaranteed fact.
So Jeremy, so what I'm understanding you say is that you could qualify, and I think we touched on this in our initial, conversation before this webinar, is that someone could qualify for a HECM loan. And tell me again what the HECM stands for.
Home equity conversion mortgage. I apologize. I use those two terms interchangeably. So the reverse mortgage as a term has been used since its inception. The HECM loan is the FHA specific loan product, and FHA branded as the home equity conversion mortgage.
Conversion mortgage. Thank you. So you can qualify, have this HICM loan there sitting, this line of credit available to you, and it stays there. And what does someone have to have, like a minimum balance or zero balance, or how does that stay in place for years and like you said, could potentially grow?
That's a good question. So yes, they have to maintain a minimum balance, but that minimum balance is like $500. Every lender is a little bit different, but that's been the very consistent across the board number. So if you keep a minimum balance of $500 on there and then just let this thing grow and grow and grow, remember, then when you were asking earlier, hey, can you ever have a more accessibility than the house is worth? The answer is yes. So I've had clients that have sat on these things for 15 years. So I was trying to refinance them because rates are down and their home's value is so high, but they just never used it. And 15 years later, all of a sudden it's like, well, hey, your house is 500, but your line of credit is like 550. I couldn't even hope to do anything for you. In fact, if anyone calls you and tells you to do anything, hang up the phone, because they're never going to be able to put you in a better position than this. You literally have the ability to have more accessibility than your home is worth. It's unbelievable.
I think that's 1 in 1,000 chance that somebody's going to pull out a HICM loan and not use it. I can see them trying to qualify because they had a need or a want, but most people have it immediately. And that's going to be a question that I'm going to have for you, if not now, later. It's like, how long does it take to qualify and get funding, in place?
Yeah, we'll definitely walk through that process.
Okay. Thank you.
So one of the other last key points of this, as far as the differences, is with these HECM lines of credit, the lender can never reduce it and they can never revoke it. And it doesn't matter what your home's value does. Your market value could fall off a cliff and rates could spike through the roof, which in that specific case where you have an available line of credit that you haven't used and rates go up, that's so good for you. It's not even funny, because that means your growth rate increases. So your line of credit is actually growing faster, even though your home value is falling. And so this leads to one of the strategies that we talk about, and they coined it the ruthless strategy. So let's say there was that example, right? And the client had a line of credit available to them of $500,000 and a house that was worth $250,000. They could literally do the draw request. The lender is contractually obligated to send them that money. They could take that money and they could walk across the street and buy a house in cash for $250,000, and that other house would get foreclosed on. And there's nothing anyone could do about it because it's got FHA mortgage insurance on it.
Wow. Okay.
So it's absolutely incredible, right? So we've had folks that say, like, listen, my mom and dad mom passed away, dad is literally on his deathbed, and they got this huge line of credit. What happens to it when dad dies? Well, if they don't access it, it goes away, it shuts off. But in that case, where if you had a home that was completely upside down and they had that giant line of credit available to them, I'd say ask for the money, take the draw. Then you got something to actually give your kids. And then guess what? Then you can go get an appraisal and then pay off 95% of that day's market value using the money you just took out as the draw against it.
Yeah, that's a very interesting perspective. And like you said, if it's sitting there, and you may not use it, but I am fascinated by the nuances of this. And so we got a good number of people that are listening in here that are actually professionals. They are real estate professionals. So thank you for being here. I really appreciate all your time. And it's important to understand the nuances of these little things. And that's why I'm happy that we have so much time with Jeremy today, is that to understand where and how it applies for your clients or how it applies to you. If you're listening to this, is just take your time, because it is complex.
Absolutely. It is. Yeah. And so I want to actually touch on one more, and then we'll take it from kind of the 30,000 foot view and dive more into some of the strategies around it, from ADUs and purchasing, especially if there's a bunch of real estate agents on here. I've got specific presentations geared just for real estate agents. So if anyone's interested, let me know and I'd be happy to do one for you. So I really like this one as a comparison, because what I found is that when you're talking to seniors, cash flow is king. In fact, it's not cash that's king. It really is cash flow, right? Because if you don't have cash flow, you can't do anything every month. So if we look at this as an example, you got a paid off house. You do a cash out refinance or a second mortgage to build an ADU, and let's say that thing is $400,000. A 30-year loan today, I pulled it up on bank rate, was 6.966 today. 780 FICO, max of a 42% debt ratio, and 50% loan to value. Your payment, principal and interest alone, is $23.21. Now remember, right when you take that loan out on a conventional or a second mortgage, you're going to have to start servicing that debt every single month. And so if you're the lucky one and you get it done in 12 months, you're paying almost 30 grand out of pocket before you put a renter in there and get one nickel out of rent. If it takes 18 months, you're paying 45 grand out of pocket almost. So that's a really long time and a lot of money to service when you're building that loan if you're on a fixed income. Now, let's say that rental income is $3,000. You subtract out the payment. That means your net cash flow is $679 a month. Now, could you rent it out for more? I don't know, maybe, but you're not paying any less than that unless you get a lower rate than that. Or if you use a HECM loan to fund that $400,000 build, the HECM monthly payment is $0. Not before, during, or after construction is a payment due. So that means if you, let's say it takes 18 months, you're not paying a nickel out of pocket to service that loan. And once it's done, your net cash flow is now $3,000 a month because you don't have to service a mortgage payment. So what does that do for a senior when you're talking about net gains? If you're living on a $2,000 Social Security check and all of a sudden you get another $3,000 a month from an ADU rent, you have $5,000 a month. You can have a lot of fun when you're retired on $5,000 a month. So a couple things I want to talk about when it comes to the HECM loan. So I already mentioned this. There's no payment required, not before, during, or after construction when you're building an ADU. Even if you're not building an ADU and you just have a client that does a reverse mortgage or a HECM loan, there's still no payment required at any given point. What happens is the loan becomes due when either the last person on the loan either passes away or moves out. Okay. There are a couple of what are called trigger events, right? One of them is passes away. The other one is moves out. You have what are called loan obligations. Okay. Loan obligations, there's three things. One, the loan has to be on the primary residence. Okay. So they can't do a loan, they can't do a reverse mortgage on, say, their rental property. But the neat thing is they can do a reverse mortgage on their primary residence and then they can use the funds anywhere they want. There's no limit to it. So you can use it on a rental property, build an ADU. You could put it on your adult child's property to build an ADU. You could build a garage conversion on your own and build a detached ADU on their property. So there's all sorts of strategy behind using that.
Let's if I can jump in, you touched on something that was really fascinating that triggered something. A person could pull out and have a reverse mortgage on their primary property. They live in it. Then they could finance the construction of an ADU on somebody else's property.
Correct.
Got it.
So think about what that does in terms of inheritance for your heirs. So most people want to leave something to their kids, right? I'm a father. I understand. I want to leave the world to my kids if I could. But it usually happens after you pass away. Imagine being able to pre-fund some of that inheritance and seeing what your kids actually do with it. You go build an ADU on your adult child's property and increase their property value and increase their cash flow. It makes their life easier, and you get to witness that as a parent. I mean, I couldn't even imagine how that's got to feel.
Well, I think that the part that I think I'm going to bring this into something that I've talked to multiple people about, and this is an issue where the parent, they want the kids have a piece of property and they want mom or dad to move on to it, but none of them have the ability to finance it. You know, the kids have their mortgage, and they're working and they have whatever sort of obligations they have. So to take on an additional, $250,000 to $350,000 debt, they just can't do it. And mom or dad is sitting, in a house, let's say like in mine in Indio. And my father-in-law lived in Indio, and that thing had, $400,000 worth of equity in it. And so, but he's also fixed income. He's retired. He's 87 years old, for my father-in-law. So in that kind of a situation, people are kind of at an impasse, because how could, and this goes back to the other slide, which is one of the previous slides, which is the home equity line of credit. You still have to have the ability to pay that off. You need to be able to show that you have income and your credit scores. So that's something that is not going to be a viable solution to somebody in this particular situation, where we're talking about a parent who has equity in their house Kids that have own property where an ADU could be built, and how do you finance it? Well, you just are talking about a very viable way to do that.
Absolutely. And so for the real estate agents listening, this is one of the things that I love teaching them, because you get a client that says, hey, I want to buy a property that I can put an ADU on, and the property is going to be for my kids, but I want an ADU for myself. But I want to stay in my house until I die. This is that strategy. They can literally do the reverse mortgage on their primary residence. They can give the down payment money to their kids as a gift of funds, and then they can fund the building of the ADU on their kids' property where they can go visit. Just as long as they keep that original home as their primary residence, they can go visit the kids, grandkids, whatever they want to do there. And then they just go back and forth. I have had lots of clients do that. And let's face it, I mean, if you're talking Southern California, I mean, they could take this money and go build an ADU in Idaho. It doesn't matter. They can go build it anywhere they want where their kids live. And then they just go back and forth. And I mean, I guess Idaho gets pretty cold and they get snow. And I personally hate snow. So
That's why we're in Southern California, Jeremy.
Right. So it's an incredible tool when it really comes to the planning of the ADU and really the long-term, where's mom and dad going to be? Where are they going to live? How are we going to spend time with them? How are they going to get access to the kids and the grandkids? You know, where are they going to be in comfort and not feel like they're intruding? And that's where that ADU is really just magic, in my opinion, because it gives them their own space, and it gives them the autonomy that every adult wants. Nobody wants to feel like they're imposing on their families if they're going to spend 2 or 3 or 4 months with them. So having their own space is critical. And so there's the solution right there. So one of the things I do want to mention though, with this, they do have to be at least 62. Now, if a spouse is younger than 62, we can work with that. It's called a non-borrowing spouse. The non-borrowing spouse in California still gets all the same protections as a borrowing spouse. They can stay in there until they pass away, even if the borrowing spouse predeceases. They don't have to make a mortgage payment, but they do lose access to the available line of credit. That's a critical, important item to know. But if you're setting this up and you're 62 and your spouse is 52, odds are good you're going to predecease the spouse that's 52. So having them being able to be in the home after you pass away and they never have to make a mortgage payment and they can stay there till they die is a lot of peace of mind for someone leaving a spouse behind.
And here's a random thing. I personally witnessed this here in Burbank, where it was a living will, where a parent got remarried and they were older. And so the living will said that if let's say it was the husband and wife, husband provided the living will to his then wife, that when he passed, the wife could stay in that house for as long, she could stay there rent free for as long as she wanted to. That if she moved out, then the heirs would then be able to take possession of the house. But this woman's children set up camp and basically ruined the house. So she was in an assisted living. So in the event that the surviving spouse has to go assisted living or moves out, that means that but their name's still on, there's not a title change, but let's say they didn't tell you to say, hey, I'm moving into assisted living, or we're moving mom out and put her in assisted living. How does that work in your mind?
Okay, so the rule of thumb is 12 months and a day. As soon as 12 months and 1 day passes, it is no longer your primary residence. It can't be, because you don't spend the majority of a year there. As far as how they determine primary residence, the wording is very vague, and it says where you spend the majority of your time. So I've had clients go into assisted living for 3 months, 4 months, 5 months to recover from a slip and fall. In fact, this client had a broken hip. So they had to go in, they needed care around the clock, basically, because they couldn't use the restroom by themselves. They needed help dressing, they needed help preparing meals. But once that was done, they moved back into the home. So there's a situation where at that point, there is a form, you let the lender know, hey, I'm moving into a short-term assisted care, but I'll be back. Every year annually, the lender will send out what's called a certificate of occupancy form that the borrower has to fill out. So
got it. Now,
if they go move into a full-time care facility, my opinion is always the same. If you don't know if it's going to be a full-time care thing, don't go jump up and say it's going to be a full-time care thing if you don't know, right? If you're going there for rehabilitation or whatever, just take it day by day. But as soon as that 12-month and a day mark hits, then you're obligated to tell the lender, hey, now it's no longer my primary residency. At that point, the loan becomes due, which means you have to pay it off, write a check for it, or if you can refinance and qualify for additional financing. If neither of those things work, then you sell the home, pay off the loan balance at that time, and keep the equity.
Well, let's say that those devil's advocate question. No
Mhm.
one tells the bank, and the grandkids move in, and does the issuance of that letter, and let's say that they're just falsifying the information. They're just say, "Oh no, I'm still living here," when the person's been in assisted living for 5 years, and they keep saying, "Oh no, she lives here."
I mean, has that probably happened? I wouldn't doubt it. I wouldn't doubt it for 1 second.
Yeah,
but
it is typically the mechanism that is put in place is that letter or that document that says, "I'm certifying that, making a statement that this is my primary residence and that I am living in here."
Yep. Where I've seen people, because I mean, these lenders are not stupid, right? They're not just, it's not just yeah, we take your word for it. Because when you fill out the certificate of occupancy, there's several other documents that go along with it, right? You have to provide a copy of a driver's license. You have to provide a copy of, current homeowner's insurance. So unless these guys are really going off the deep end and flat out just committing loan fraud, then, they're probably
so
not
those
gonna
are
get
the
away with it.
mechanisms, because I'm trying to play devil's advocate. Which is eventually going to happen to all of us. We're not going to be able to take care of ourselves on our own.
Mhm.
And you're going to need some sort of assistance. And that with a reverse mortgage, you just need to kind of keep in mind that there are certain mechanisms in place that if you are a surviving spouse, that if you move out, then then the home, is going to be, go back to the bank.
No, it's not going to go back to the bank. I want to be very clear. You still own it. So you still have the ability for it. Your name's on the title. The bank goes on the title as a lien, just like any other mortgage, right? You show up in first position, second position, wherever. With reverse mortgages, by the way, they always go in first position. But yeah, there's no going back to the bank unless they literally just walked away,
right?
And they go move into a facility. Now, the only way I would ever recommend that is if someone called me and said, "Hey, Jeremy, I'm completely upside down in my house, but I'm going to go move into assisted living. What do I do?" Well, in that case, walk away, because that's why you paid for the FHA mortgage insurance. That's literally exactly what the mortgage insurance is designed to do, is cover those instances. So you go walk away, you go move into the care facility, you pay for that out of your own pocket. That's what you're going to do. If there's equity, I would never tell them to walk away. I would tell them to contact one of these fantastic agents that's on the call with us. And I'd say, go talk to one of those agents, have them sell your house. You get to keep the equity that goes in your bank account. You go move into the care facility and live the rest of your life out.
And you pay the balance on the loan.
Correct. Yep. So yeah, so and we kind of covered several things there, right? Having a home upside down and just walking away versus still having equity. And there's strategy to which one you would pick based on your scenario at that given time. So I do want to point this out because I know you're going to bring it up later. And you're going to say, well, what happens if I need equity later and the reverse mortgage has used it all? What happens if I get to that point? And that is a risk that you take. The difference is, though, is you still have that home. You're not required to move out, even if you're completely upside down. Now, what we've had a lot of times clients say, "Hey, I'm basically at my limit. I basically borrowed this and I had the intention of saving it and letting it grow, but I just used it on this and used it on that. And, now I'm out of money. And now what? Now I need some help." Well, a lot of times they'll move in a child, an adult child, or a relative, and that relative will provide care. Or if they have long-term care insurance, they can also use some of that money and they can bring in a long-term care provider and provide them room and board, which reduces the cost of those things. So I've had clients have care providers move in, and they're 2 care providers in 2 different rooms in the house so that they can have round-the-clock care, and they switch shifts and their care is provided for them, and it doesn't cost them an arm and a leg in order to cover that care.
Got it. Okay, that's a good idea.
So next, I want to talk about the planning, right? So when do we start looking at this? So, David, I know you've got a lot of experience with building ADUs. While I've never personally built my own ADU, I've got a lot of experience in the planning process of it because I've worked with a lot of builders. Okay. And so I think you would agree with me. The most important time to do this is at the beginning. So you actually see how much money you're working with, because there's no reason to plan for pie in the sky if the pie is not possible. So this is where the economic reality really, really comes into place. And so when you do a reverse mortgage on your primary residence, you're going to start the loan process immediately during the idea and design phase. And you don't want to really go past that. You don't want to go start doing permits or anything like that. You don't want to solidify anything because you want to see what you can actually qualify for before you go commit to those things. Once you know what you qualify for and you have the money, you are in control of that money. There's no fund control manager. You get to decide what to do with it, which is very important, right? Now, David, I know you work as a fund control manager occasionally, correct?
Yes.
Okay. So I also understand the importance of those, especially for folks that have never built anything, right? Because not every contractor has scruples or morals, and it's important for them to understand how to use that money. But whenever I talk to a client about building an ADU, I always make sure, especially for me, I refer them to folks that actually have integrity when they're going to be a contractor for building an ADU, because nobody should get paid everything up front.
No, and you're absolutely right. And hopefully a lot of people are smart enough to not do that. But there are the occasional that just kind of get taken care of. And this is the part that I think that there are people in that, and I think we might talk about this, is that when you're doing an ADU build and you're using a reverse mortgage, a HICM loan to do it, it's not like a refinance where you're given all this money up front, and as you mentioned in an earlier slide, having to pay interest on that, from day one. This is something that you're going to be able to take out the cost of the fees for the design or the architect. You're going to be able to then get your plans done. You're going to be able to take out the money when you submit for your permits. And then when you get your permits back, then you're going to be able to start those initial payments to the GC as your build kind of commences. So it's going to be, again, you're going to have this approved amount of money, like you're saying, Jeremy, know what you have to work with, but you're not taking it all at once, and you can take it as you need it.
Exactly. And the other neat thing about that is, and I always coach my clients to do that, right? Don't take all the money and stick it in your bank. There's no reason to. The reason being is because, remember, the unused portion of the line of credit grows over time. So if you need 20 grand up front for a permit, and then 20 grand for site prep or 30 grand for site prep, you write those checks as they come, and the remaining line of credit is continuing to grow over time. So if you're sitting there, you pay the initial money up front for the permit, and then it takes 4 months to get your permit, or 5 months to get your permit, or 6, whatever it's taken in your area right now. That line of credit is continuing to grow. And then you go, okay, now we're ready for initial pre-construction work, right? We're going to start the grading, and we're going to start looking at laying the foundation, and we're going to start the stub outs for the electric. All those things have those costs, but they're at that time, right? So that whole time that line of credit is growing. So you can actually ultimately end up strategizing and having more money on your line of credit available to you later on, rather than taking it all out, sticking it in the bank, and then your line of credit doesn't grow, because it's the unused portion that grows over time. And ultimately, what we really like people to see is having an available line of credit even after they've spent the money to build their ADU completely, because that remaining unused portion will still grow over time. So then they'll have the cash flow from the ADU, and they'll also have an available line of credit, which I actually have an example of that we're going to get to in a minute. So there's a couple details about this that I want to make sure I cover. I think I already went over this. The loan has to be on your primary residence. When they do the appraisal, they base it on today's value. They do not base it on, hey, I'm going to build an ADU, or hey, I'm going to add an addition on my home, or hey, I'm going to remodel my home. They don't do that. They base it on today's market value of whatever the home is. Now, a little known or very uncommonly known fact is that you can actually refinance reverse mortgages. So let's say we do this loan. It's based on today's value. We get you X amount of dollars. You build your ADU. Once the ADU is done, that should perceivably add value to your home. At that point, you are now older, which increases your accessibility. If rates go down, that'll increase your accessibility, and you've now added square footage to your home, which increases the value. All those things add up to the capacity to refinance that reverse mortgage and potentially access more money. You don't have to if you don't want to, but it gives you the option to. But a lot of people I've heard, they just say, oh, I can refinance a reverse mortgage. That's unbelievable. I never knew that.
So let me interject. So you can take, it's not when you said, my head went to another place.
Mm-hmm.
When you said refinance a reverse mortgage, you're talking about getting a brand new reverse mortgage.
Mm-hmm.
Okay.
Later on, after you, so it's again, this is long-term strategy, right? This is not today. This is step by step, because there's a lot of people after as SB 9 that passed, so you can build
Yep.
more than one ADU on your property.
Yes, you can.
So you could build an ADU today and then sit on that line of credit for 2 or 3 or 4 years or 5 years until you have a dollar amount that you need sitting in that line of credit. And then you take that money and build a second ADU on your property. So there's some strategy to that, right? So let's say you don't get enough growth in the line of credit, but you've got enough increased value that you can look at it and say, hey, now based on this new increased value with this primary residence and the ADU built, we could refinance this thing and take your line of credit from 150 to 300,000 just based on the increased appraised value. So we have the ability to refinance them if you qualify for it.
And not that I would suggest that anybody do this, but if they had the reverse mortgage and they built the ADU, the ADU's there, they now have this value, because let's say it's in Burbank and somebody went from an $800,000 primary single family residential house to something that's now worth 1.4 million with an ADU in the back. They could refinance just to and let's say the rates really came down, not to where they are now at almost 7, but they came back down to maybe 4. They could refinance just to refinance and pay off the reverse.
Absolutely. That's a great point. Yeah. Let's say they had the financial capacity, right? They have the income because of the ADU and they've got the credit. Because remember, in order to use rental income, you have to have it for 2 years. Otherwise it gets averaged over 2 years. So if you have it every single month for 2 years, then your average is whatever your rent is. So if that gives you the capacity to refinance, absolutely, you can refinance out of a reverse mortgage into a traditional loan, just as long as you qualify to take out the loan for the traditional mortgage.
Of course.
So, and I've had lots of people do that. In fact, one of the things I've been showing people is they say, hey, you know what? I don't want a reverse mortgage forever. Perfect. Let's do this so that you don't have to pay out of pocket every month for the next 18 months. At the end of it, you should be able to qualify for a traditional mortgage. Go refinance and do a traditional mortgage then.
Oh, so I had a question, a really good question that came up in the Q&A, and I'm not sure if I want to drop it now. How many more slides do you have?
What are we on? 11, 7, I have 6 more slides.
Let me.
If this fits here, let's ask it, because
let's do this. This is from Carolina, and thank you very much for this question. This is excellent. She goes, "Hi, Jeremy. My sister, who is 70 years old, is moving in with her, so that Carolina can take care of her. If Carolina adds her sister to her title, would that qualify them to be able to have a reverse mortgage?"
So short answer is no, but there's a way to do that. Granted, ultimately what end up having to happen is the sister would have to own the property. Now, just to clarify, I want everyone to understand, I am not an attorney and I'm not giving legal advice. I'm not a title attorney nor a real estate attorney, and I'm not giving you advice on how to change the title of your home. What I've seen is people put homes in trusts and make certain people beneficiaries of said trusts, because a trust is a legal entity that owns assets or property. Now, what was the woman's name? I'm sorry.
Carolina.
So if Carolina owns the home right now and she put it in a trust, the title would change as far as ownership, right? And if she added then her sister to that, she would have to talk to an estate planning attorney is the direction you want to go to talk to them about that, because ultimately they would have to own it. And then the loan would go in the name of the trust along with the home.
So it absolutely does make sense, because Caroline, I think that the part that Jeremy is saying and touching on is that there are ways to be able to do it. There are things that you kind of need to keep in mind of what the ramifications would be. I mean, who besides just you and your sister are in your family? Does she have any beneficiaries? And the trust mechanism is a very powerful tool to be able to, for you to be able to give specific instructions, and just so things happen the way that you and your sister would want them to happen. Because you as an individual, and if you're going to be doing that, which is wonderful, God bless you, is that that's a lot of time and effort and work. And you're looking at having your sister be able to come in, who is over 62, I would think, and that having her on title or being the owner of that property, then you could then access your equity. Because I think that's what you're asking, is being able to access that equity that's sitting there, not used, and there is an immediate need.
Well, so there's a couple things. One, the reverse could work, right? Where Carolina, she could move into her sister's home, right? If her sister owns a home, and then do a reverse mortgage on that property. If Carolina happened to sell her home, she could do a gift of equity if there was an imbalance in where they needed to be in order to get the reverse mortgage, just to get rid of a mortgage payment. But I also wanted to touch on the thing you were talking about, the implications of doing this. You guys have to keep in mind, right? Again, I'm not a trust attorney. I'm not a real estate attorney, and I'm not giving you financial advice. I'm specifically saying, don't go do this. Go talk to an estate planner and see what they think about it. But you have to keep in mind the tax implications, because changing ownership is going to potentially create a tax implication from the value of your home. You're going to lose your cost basis on your home by transferring ownership. The second thing is you're going to potentially lose your tax rate. If you have a tax rate because you've owned the home for 15 years and you increased whatever 1% or 2% annually, you have a much lower tax rate on that property than you would have by changing ownership now today. So just keep that in mind. There's a lot of stuff. There's a lot of moving parts to this stuff. And if you were thinking of doing that, go talk to some estate planners, get a couple different opinions and see how they think about it. But just know that you would also basically be giving up ownership of your home to your sister, ultimately, is what it would be. Which is,
yeah, but if Carolina, accessing those funds is the most critical, there are ways to do it. Jeremy is making a very important point, to be conscious of what the effects are long term to you. And if those do make sense, you know, by all means. Estate planning attorneys will have most will have an initial call with you at no charge. Thomas Christopher is somebody here in the San Fernando Valley that we had on the Ask a Pro webinar. He's brilliant. There's also an estate planning attorney that I met at the Burbank Association of Realtors today. Most all these people will have a chance just to say, okay, just like what Jeremy is doing. He's saying, he's qualifying to say he's not in that business, and you should talk to a professional that's in that business so you truly understand the ramifications, because they are, you know, significant.
So one thing I do want to add. So as an aside, Carolina, if you want to reach out and email me and pick my brain, and you actually talk to some estate planning attorneys, maybe we can get on a 3-way call with them and they can ask questions and I can ask questions and so can you. But remember, it has to be done on a primary residence. So for you to establish for your sister to establish primary residence, it has to be her primary residence for at least 30 days. So just know that, right? And now, can you change ownership of a home? Of course you can. Can you gift a home to your sister if you feel like it? Of course you can. But just talk to an estate planner before you make any moves, because it could work out perfectly, but it could be catastrophic for you. So just do that. And again, I'll be a resource to you. I'd be happy to.
Yeah. And Carolina, if you could just drop your email address into the chat. So Carolina, if you could just kind of go over there and grab it. And if not, you did register for this on Zoom. So I do have your email address. And if for some reason you don't get it, I'll be sure to send out a follow-up saying that and asking if you did get everything, because we really do appreciate the question, because it's important to you and it's important to a lot of the people that are watching and who'll be looking at this in the future. So thank you for that, Jeremy. I'm glad we dove into that.
I just put all my contact info in the chat.
Great. Appreciate it. Okay. We got about 6 more slides.
Okay. So strategizing, and here you can see on the right, you can see what the line of credit looks like. And I'm going to kind of just back out the camera for a second. So this example is based on somebody with a paid off home. They're 62 years old. The home is valued at $765,600 at that point. And they wanted to build an ADU, and the ADU at that time was costing $180,000. Now I will admit this is a little bit older example. So rates are a lot lower on here. And ADU builds are a little more expensive at this point, but it still works for the scenario. So we do the loan on the primary residence, and in this case, they wanted to build an ADU on their own property. So we start at the design phase, and then we look at long term, right? What are you doing this? So when I talk to people about ADUs, I always say, what do you want this for, right? Are you already retired? Are you going to move the grandkids in? Are you going to rent this place out? What's the purpose of this thing, right? And most of the time they want to rent it out, so they want cash flow. So then we look at things like, are they already retired, right? If somebody's 62 and they haven't retired yet, retirement age right now is 66 and a half, and it's going up. So we've had folks do the reverse mortgage to get rid of a mortgage payment so that they could retire early without touching their Social Security yet. So we look at what's called their cash burn rate. Everyone knows what a cash burn rate is, right? If you have any expenses. So you look at the cash burn rate and you do a comparative analysis based on making a mortgage payment versus not making a mortgage payment. And where is that delta where it makes sense to actually retire early or retire now? The other thing is delaying Social Security or not. I just did a loan for a guy who had every intention of waiting until he was 66 and a half. So in that case, he would have been just shy of 2 years to wait till he turned 66 and a half. He was not collecting Social Security. He had basically, let's call it forced retirement from COVID. He was a consultant, and COVID kind of broke the legs of his business. So there's really no going back. 65, he just didn't have the energy to just go rebuild again. So he had a decent chunk of money in a retirement account, but his burn rate, because of his mortgage payment, which is like $3,000 a month, his burn rate was like $6,500 to $7,000 between everything he was paying. So you're talking about $80,000 annually in a burn rate. He was down to less than 300 grand when I met him. And so we looked at doing the reverse mortgage for him, and we were able to get it done. And not only that, we looked at his Social Security and we did the math on it, and it penciled out. He would never catch the delta for delaying the Social Security because his increase was only going to be like another $400 a month. And he could start collecting like 2,400 right now versus like 2,700-ish later. So he would never, ever actually catch that number. If you took that money that he would collect over the next almost 2 years, he would collect almost 50 grand. And so in that case, waiting for an extra 400 a month, it would have taken him like 200, like, what was the number? Like 200 months. I'm going off the top of my head here. I apologize. So basically what amount to nearly 20 years to catch that. And he just never would. He would just never make up the money because his life expectancy wasn't that long. He's like, I'm never, like, everyone in my family passes away in their early 70s. I'm like, well, what are you waiting for? Get rid of your mortgage payment, start collecting Social Security. It basically increased his net cash flow by almost $6,000. And so then he got to stop drawing as much money he basically had to stop drawing almost all of his money out of his retirement account and basically just use the Social Security to live payment. Comes to the strategy for long-term stuff is so important. Now he lived in a condo, so an ADU is not really in the cards for him. But if you find somebody that has this scenario that does have a single family or a duplex and they can build an ADU, they can go build this and they can delay Social Security or take it. And then the remaining line of credit is what actually grows over time. So if you look at this example, there's a line of credit after taking out $180,000 of $210,000. So I'll leave you to do the math. If you say, well, what if it was a $220,000 ADU? Well, just subtract another 30 grand out of that line of credit. But in this case, this has a growth rate of 4.293%. Now, growth rates on the current lines are in the mid sixes now because rates have gone up.
And that's what you've been referring to multiple times. You're talking about growth.
Yep.
There's a percentage that you're mentioning now of 4 or 6%, that whatever that unused balance of the reverse mortgage is now growing by 4 to 6.
Correct. Yep. So in that case, if you look at, so remember, this homeowner is 62 years old. So they have now an ADU built. They're cash flowing $2,000 a month out of their ADU that they built for 180 grand. And they've got this line of credit sitting there of $210,000. So they don't need to do anything right now. They've got their Social Security and they've got their rent coming in from their ADU. It cash flows their whole life. So you and I both know that stuff happens, right? Life events happen. So that might require some draws on that line of credit. But if they don't, and they just leave it alone, in 10 years, it's gone up almost 50%. It's up to $315,000 in an available line of credit. Now they could feasibly go build another ADU in their backyard for another, well, in that case, it's probably going to cost them more, probably $250,000. But
yeah, it would.
now, right. So now they can go build another ADU, increase their cash flow even more, or they can let this thing sit. Because remember, at the 10-year mark, they're 72. And at 72, most of my experience with clients in their 70s is they're tired, their body's hurt, but things haven't really started breaking down yet, right? As far as cognition, inability to feed themselves, inability to bathe.
Right.
But you go 10 years more down the road and now you're 82, and that is the magic number when it comes to deterioration of health. That is where odds are good you'll need help doing 3 of the basic necessities: dressing, eating, and bathing. So now at this point, they've got nearly a $500,000 available line of credit on top of the rent from the ADU, plus their Social Security. So now they can start drawing on that line of credit to start paying for in-home health care, because that was their big concern. They didn't want to go into a care facility. So almost 500 grand goes a really long ways when you're talking about, if the cost of care is 10,000 a month, well, pull $7,000 a month out of that and cover the difference between your Social Security and your rent from your ADU. So that gives you a really long runway in your house. Because remember, the remaining line of credit continues to grow over time.
Right. And I think that this kind of gets to one of the things I wanted to kind of point out. So in the scenario where you have, in this illustration, 210 left on the line, and then as it grows to 315 or 472, whenever you start and you decide you want to start pulling that out, that's how much you have
available to you. Yes.
Okay. So you're pulling it out at whatever rate you're pulling it out. If you're pulling it out at $2,000 a month or $10,000 a month, that's your burn rate of accessing that reverse mortgage. And so, and when you get to the end of that, then that's done. So there's it's not into perpetuity. It's not in forever. It's just when you use it, it's taken away. And now you don't have to move out, but you've now used the maximum amount of it.
So one of the strategies that I teach people is, in this case, let's just look at the number 210,000. So that's going to grow, just for easy math, we'll call it 200,000 at 5%, right? So that means that line of credit will feasibly grow about $10,000 annually. Okay. So there's a couple different ways you can use that. You can say, you know what, give me about $800 a month. I'm going to draw that $800 a month off. Then you still have that full remaining line that's going to continue to grow by that amount each month. Or I've had clients wait till the very end of the year and say, what did it grow by? Okay, it grew by $11,000. I'm going to draw that $11,000 and leave the remaining 210,000 there. So now they have that 10,000 or 11,000 to spend over the next 12 months while still having that line of credit. So what I always tell people is this: unless you have an actual specific immediate need for that money, do not draw on that line. There's no reason to, right? If you have 60 days of expenses in the bank in the form of cash, that's perfect. Leave the rest on the line of credit to grow and actually do what it's designed to do, which is grow over time.
Do not do a reverse mortgage to pay for your kid or grandkid's car or pay their credit card off. Be smart about it, is what you're saying.
So, well, I'm gonna contradict you there. I'm not saying don't do that, right? Because in that case, we look at that, something like that could be pre-funding inheritance, right? You have a car that you're gonna buy, right? I've had lots of clients go, you know what, I really want to buy my granddaughter a car. She's going to college now. She got into a great school and I really want to help her out. Well, the only way I can help her out is co-sign. No, don't do that.
And that's kind of what I was wanted to kind of, jump in and say that is because the older parent or grandparent is very caring and nurturing and wants to be supportive. And if somebody goes to them and say, hey, mom, dad, grandma, go get a reverse mortgage so I can do this. So
yeah, you want to go spend it on Vegas, you want to go spring break it up, I would say no, absolutely not. Don't do that. Never. But you have a responsible adult child that you're trying to help out in the world, by all means help them out,
and you can access it and do it. Got it. Yes,
good. Absolutely. Right. And better this than spending the cash in your bank, right? Because ultimately, if that's the inheritor, they're just pre-spending their inheritance. That's all that's going to happen.
Yeah, and I think that's the other part. When you say pre-spending inheritance, and this is one thing that we've had to have conversations with my wife's sister and some other family members, is because we have the ADU and we built it. And it was $300,000. We paid for. And that's a lot of money, but we're also not collecting any income from this ADU, which was our initial intent. Our initial intent was to show it as a model and rent it out, because here in Burbank, we get, $3,800 a month, easy. And it wouldn't have been a problem. So the fact that we're foregoing any sort of rental income, and you talk about inheritance, and we're hoping that, my father-in-law Chuck lives forever and there is no inheritance, that would be a blessing. But then again, we also have, if there is inheritance, and this is getting a rabbit hole, I'm sorry, thank you for your patience. But if we were to say that we're losing $3,000 a month and he lives for 10 years, that's a lot of money that we had not collected by having Chuck here. Now, I'm just saying that that's a business type of looking at the finances. And when you talk about inheritance is very, very complex. Talk to estate planning attorneys, put all of your ducks in a row and flush out these things before you jump into it. So anyway, thank you for that aside.
Yeah. And put everything in writing, because I can't tell you how many times I have come to the end of these situations where everyone is nice until there's $1 million on the line. And then
100%
the knives come out. It's unfortunate, but
they will. It's not if, it is when and who.
And for something like that, that goes back to the opportunity cost that I mentioned earlier in the presentation. You have the opportunity to make nearly $4,000 a month. Compound that out over the next 10 years. It's not just 4,000 times 120 months. If you went and stuck that in the stock market and got 6%, you'd have a lot more than 300 grand. I'll tell you that. So, yeah. And I mean, I don't need to tell you that.
We've looked at it, Jerry. It is the opportunity to have dinner with Chuck 5 times a week. My wife to have tea with him in the evenings at 9 o'clock. And the fact that he'll sit there and say, those gosh darn SOBs yelling at the TV. It's all great.
And those things are priceless, right?
They are.
But at the end of the day, it has value to your bottom line eventually. So yeah, it sounds like you're addressing that, and I'm glad you are. But yeah, that's definitely something to be aware of that can happen. And yeah, definitely get those things in writing, because my gosh, that can be a lot of money over a long length of time.
Definitely is.
Okay, so these are some of the common uses. So when it comes to renting an ADU, it's not just about the rent, right? And one of the things I always caution people about is that, hey, you realize that when you say I want to build an ADU and put a renter in there, that means you're going to become a landlord. And some people, when you put it like that, they're like, wait, I don't want to be a landlord. So then you have to consider who you're going to rent to, right? So, and what do you want to use it for ultimately? Because ultimately the use a lot of times will outweigh the fear of being a landlord. So they'll try to usually rent it to somebody they know early on, and that's great. But as far as what they're using it for, right? People have used this thing to pay for travel expenses. I get to go see if I'm pulling in $3,000 a month net cash flow off of this thing, I can go visit my grandkids once a month. I can buy the plane tickets and the rental car, and I'll go do that stuff. I can participate in any hobbies that I might have put on hold while I was raising kids. I actually had a client do a reverse mortgage. I've actually refinanced her again. She is 98. She's got in-home care. They use a room in her house for room and board to reduce her care costs, but she was using the reverse mortgage to pay for those things. But when I first met her, she had a medication that was, I apologize, I'm not going to remember the exact number, but it went up so much money because she was living on just a Social Security check. It went up so much money that when she went into the pharmacy to get her medication, she left without her medication. And it's a heart medication she has to take. And I was floored, right? That was the first time I had ever heard somebody say that to me personally. I know it happens, but that was the first time in my own life that I was just like, what do you mean? You need this medication to live? Like, how can you not get it? And so, but Medicare would only cover a certain portion of it. And because of her Social Security income, she couldn't qualify for Medicaid. So she's stuck in this very weird limbo of basically needing it and not being able to have it. So when we got her the reverse mortgage, I mean, she was in tears. She just couldn't even believe it, because now she's got her medication until she passes away. She'll never have to worry about the cost going up on it.
And I think that the one thing is kind of in my mind right now, listening to you, and I have to say that I really appreciate the fact that we have the participants that are here listening with us live, and so thank you again. We really appreciate you being here. But when you're looking to the real estate professionals, or anybody who's a professional with accessory dwelling units, and you're talking to somebody who has equity, and that, and they may not have income, because that's usually what most professionals default to. That's what I default to, is what can you qualify for? What can you qualify for? What can you borrow? Because that's what most real estate agents or professionals are like, what are you qualified to do? And this reverse mortgage can really change that significantly if there is equity and the person is over 62 and it makes sense for them. So it's something that's difficult for me. And so that's why I'm so excited that we're having this conversation. You can look at a person in a situation differently, and you can explore those options with them. And I would recommend that you don't need to become a super expert in this. I mean, you're learning more now or hearing more now than, I think you don't need to know and remember all of this. You need to know who to go talk to, whether it's Jeremy or it's someone in his office like Denise. You're going to be able to reach out and get in touch with somebody and then bring them into the conversation with your client. Let them ask the probative questions. Let them just really run through this to see if the product is going to work, because it is just to say this kind of repeated, this term, it's another arrow in your quiver as you are talking to people. And I think that is probably one of the most powerful things you can have as a professional. And it is the most significant thing you can do when you have the trust of your client, you have to protect that and nurture it. And I think this is just have the conversation with them if you think it may be an option, so that everybody can kind of consider it. So thank you for letting me jump in to say that, Jeremy.
Absolutely. And every time you do this, I think of extra things to add. And so I'm going to add this since we're on this topic. When it comes to real estate agents, there's a lot of agents that don't know this. You can actually use the reverse mortgage as a purchase tool. And so we teach it, we call it right sizing. So let's say you've got the 75-year-old client that has a 2-story house. They raise their kids there. It's a 4.2 and 2,800 square feet, and they just don't need it anymore. They can't even climb up the stairs. They can sell that home. So here, agents, this is really critical because this means a lot of commissions for you. You can sell that home. Then you can use the reverse mortgage as a purchase tool so that they can buy a new home. And if you're shopping for a home that has a space big enough to build an ADU, Dave, you can build them an ADU. So, and we can do the reverse mortgage on the new primary residence using the proceeds from the closing. And then a lot of times, because you're talking, it's not dollar for dollar, right? You go buy a $800,000 house, you don't need to put 800 grand down to get a reverse mortgage. You can put, depending on their age, 40 or 50 or 60% down, and then keep the remaining equity. They can use that to build the ADU in cash, or if they don't want to build an ADU, they just, my recommendation is I would give it to the financial advisor. Don't keep it in the bank. But if they do that, I mean, that's a great strategy for them to build a right size, because they get to keep their tax rate. They get to move that with the house. They get lower expenses and lower utility costs by moving into a smaller or a 1-story house. So if you have questions about how to use it as a purchase, please reach out to me, because I'd be glad to walk you through it.
Thank you for that.
So, all right. So let's get back to this, the in-home caregiver. So reducing healthcare costs. The next thing is, when you're building an ADU, what I always recommend to people is, if this is a forever home for you, if this is the home you're going to age in place until you pass away, and you're going to build an ADU, think in terms of ADA accessibility. Think in terms of when you're positioning your ADU, where are you going to put this thing so that I can add a ramp later, so that if I need a wheelchair, if I have a walker, how can I get into this house that's 2 feet off the ground because of the foundation? Because I can't do stairs. Think in terms of wider hallways, wider doorways, maybe slightly lower countertops, walk-in showers. The number one place senior citizens get injured is stepping into or out of a bathtub. And so they have a slip and fall, and they injure hips, femurs, shins, ankles. And when you're over a certain age, your body just doesn't heal the way it does when you're younger. So these things can be catastrophic. I knew one client, he actually had a slip and fall, broke his hip, went into the hospital, and 3 weeks later passed away because of an infection in his hip. And it wasn't like a compound fracture. It was because he was 82 years old. So think of these things in terms of accessibility for later when you're planning the long-term stuff. The other thing is the ADU, you got brand new construction versus your house might have been built in the 50s or 60s or 70s. Maybe it had a remodel, maybe it didn't, but that's brand new 2023 materials, construction code. You have all the modern conveniences. So you have the nice, the nice windows, the triple pane windows, and you got a lot of times solar on the roof. So your utility costs are much lower. Then as you age in place, you can also move into the ADU and rent out the larger residence for more money. So when it comes to planning the ADU, what I always recommend is this, right? Build the ADU that you can afford to the biggest of your ability. right? So don't just go, I just want a studio back there. If you can build a 1-bedroom, because studios have less demand than a 1-bedroom. If you can get a 2-bedroom 1 or a 2-bedroom 2-bath, build them as en-suites, because then if you need to move into that ADU, eventually you can live in one ensuite and you can rent out another ensuite, or you can put a care provider in an ensuite. So it gives you more options later in life. So just think about that. If you're talking to clients about building an ADU and using a reverse mortgage for a long-term tool, those are the things that I always go over with them. Dave, did you add anything to add in there?
No, I think you covered it.
Okay, wonderful. So the uses that I like to talk to my clients about, I really like to kind of dive in. Reason being, a little background, my dad, he worked for General Electric for 36 years. He spent most of his adult life traveling all over the world, working in power plants. So when he retired, I was like, Dad, what do you want to do? What are you going to finally do with your time? And he's like, I don't know. What do you mean? What about your hobbies? He's like, yeah, you kind of forget about hobbies when you're basically working 80 hours a week and you're in China for half of your life. He's like, the hobbies just kind of disappear. And so I like to play the what if and the kind of the hey, what did you like game with folks to get their brains kind of moving to think about what they actually enjoy doing, or what the things that they feel like they missed out on, or maybe some of their bucket list stuff. Which I mentioned that client that bought the RV. That was their ultimate dream. And the husband was 72 and the wife was 61. She was a non-borrowing spouse. But she was going to work for 5 more years till she should get Social Security, and he was going to be 77. And I was like, well, what do you guys want to do? He's like, well, by the time that happens at 5 years down the road, we can refinance the house because the balance will be lower. She can quit working and collect Social Security. And at that point, we'll be able to afford to buy an RV and then travel around. And my only question to him was, do you think it's going to be easier to travel around at 72 or 77? And he started laughing. He's like, well, duh, 72. And so I was like, okay, let's look at this reverse mortgage as a tool. You have enough money to take out, to go buy an RV in cash and get rid of your mortgage payment, which means your wife can literally retire as soon as we're closed. Please don't do it beforehand, but as soon as we're closed, your wife can retire and you guys can go do this. And they're like, let me think about it. 2 days later, they called me and they said, let's go. And so we ended up closing 35 days later. And they went and bought their RV, and it was in December. They ended up buying their RV in January, and they went and drove around. It was, and I still get calls from them to this day going, this is amazing. Like, I can't believe we get to do this.
Well,
So,
but it's being able to have people get comfortable with the idea of a reverse mortgage, understanding what it means and the opportunities it presents them.
absolutely. Yeah. And and everyone's situation is different, right? The loan itself is relatively the same, right? The line of credit is the same, whether it's for you or you, depending on the size of the line of credit you have access to and your immediate needs and long-term uses for it. But as far as how you use it, it's really going to come down to what it is that you need in your life, right? Not everyone's going to want to go buy an RV and drive around the world or around the country.
Right.
You know, some people literally, I've had clients that literally said to me, Jeremy, I literally have to blow out my pilot light on my heater during the summer months because I can't afford my gas bill. And that to me is no retired life.
Yeah, no, that's not, and that's a lot of stress that people are dealing with.
It is, and they're sitting on 800 grand in equity, and it's like, you don't have to do that.
Well, this is also too that I kind of feel for. I'm very active locally with politics, with the city council, with all of the things that are kind of happening because of, I'm not going to go into why, but I really started to look at utility companies, so here in Burbank, they have the Burbank Water and Power, and they have a board, they have a board of volunteers that are community members that kind of oversee, they don't manage it, but they oversee the utility. And one of the things that they recently came up with is because of COVID, there was a moratorium on having to go and collect unpaid utility bills. And the part of me kind of went, well, oh, those are just a bunch of deadbeats and they deserve to be kind of go into collection. But the other part of it is, as you're kind of touching on, and we've touched on it several times, is that older person who just is trying to balance out, do I pay for my heart medication or do I pay my water bill? And so now the water company is going, it's time to collect. And these people may not know that there's an option out there. And it doesn't matter if their old house in Burbank is kind of dilapidated, it's still worth $750,000 and it may have a zero balance on it. So again, I say this is a tool. It's a powerful tool. If you know people and it may be helpful, just reach out to Jeremy and his office to be able to kind of dive into this and explore it.
Yeah, I mean, that pretty much sums it up right there. So
Good.
yeah, there's all sorts of uses for this thing, really, and it's just a matter of figuring out what it is that your client wants to do, right? I mean, we've had clients that were like, well, I want to buy a condo because my daughter got accepted to Arizona State. Can I do that? Yeah, go write the check for it. Daughter gets to live there. She gets to have a roommate. She gets to collect the rent from the roommate, so she gets some fun spending money. Grandma's thrilled. So there's all sorts of stuff that you can use this thing for.
Yeah, no, it's absolutely. Carolina had another question. Let's kind of throw that up there because I know we're getting close to the end of the slides. She was wondering, it's like, your question was, so are you not required to have a reverse mortgage in order to get a HICM to build the ADU?
Yeah, so like I said before, I use the terms interchangeably. A HECM is an FHA insured reverse mortgage. So yes, in order to access the HECM line of credit, it's a reverse line of credit. It is a reverse mortgage.
Same thing.
Yep. Now, there's one thing that we really haven't dove into because that's a whole nother can of worms, and that's the proprietary reverse mortgages. So they're underwritten the same way, as in they're non-recourse loans. You can never have more on the house than you're worth, than it's worth. The difference is with those ones is you don't have to follow the HUD guidelines. And so these proprietary reverse mortgages are more for the jumbo crowd that has, I mean, we've done loans for people where they've got an $8 million house and they do a $3 million reverse mortgage. With a HUD loan, with the FHA insured stuff, you have a lending cap. That lending cap is $1,089,300 today. So that means whatever the value of your house is, if you want an FHA insured reverse line of credit, a HECM line of credit, the maximum value that they'll use is $1,089,300. The remaining equity is still there, but they base all the percentages of accessibility on that $1,089,000. So let's say you could qualify for, let's just use the number 30%, right? We'll get into the details later on an individual basis, but let's say you qualified to access 30% of the value of your house. So that means if your house is worth $2 million and you wanted an FHA insured HECM line of credit, they would use that $1,089,000. So you'd get access to 30% of that $1,089,000. So if you had a mortgage to satisfy, it would have to come out of those proceeds first, and the remaining money would be yours to use.
And is that kind of a set guideline? Is like it's 30% of the equity?
No. So it depends on the product, and it depends on the age of the borrower. So there's a tier system, and it's a sliding scale. So the older you are, the more accessibility you have. 62 being the youngest age for the HECM, but there is no maximum age. In fact, my oldest client was 104.
Oh, goodness.
Yeah.
So, okay, I want to wait until you're done because I do have questions because we have just 30 minutes left, and
okay,
we're going to blow through these
we're
2 hours.
We're almost done. We're almost done with these slides. This just goes back to what we already kind of touched on, so we won't really spend a ton of time on it. But as far as legacy planning, right? People say, I want to leave something for my kids. Well, you pre-fund their inheritance now and build an ADU on their property. You're really leaving a legacy for them. If you build an ADU on your own property, they have the potential to turn that into a rental property. Now you're leaving more legacy for them behind. Because remember, when you build an ADU on either property, you're going to increase the equity that is in that property because you're adding value to the home. When it comes to estate planning, if people have multiple rental properties and they want to add multiple ADUs, right? It might take some time. They might be able to buy, build one ADU, let the line of credit grow, build a second ADU on another rental property. But remember, you're not increasing the loan balances on those rental properties because the loans aren't going on those rental properties. You're simply increasing the cash flow on those properties. So if you're talking about estate planning, you say, hey, I want to leave a rental property for each of my kids. Well, now you can leave a rental property with an ADU on it for each of your kids. So now you're leaving more cash flow every month. And really, ultimately, if you talk to an estate planner and you set the stuff up right, you're talking about generational wealth. You're talking about wealth potentially in perpetuity if you structure that in your trust that way. I mean, you could write, I've had people write in trusts that say, my grandkids are going to get college paid for when I leave this. Excuse me 1 second.
Sure, no. And I think those are all kind of things to kind of keep in mind as you're doing it. And even though these are there are fundamental components of a reverse mortgage that are going to be of benefit. And I think that's what you need to just kind of keep in mind if you're looking at it for a client or you're looking at it for yourself.
Absolutely. So this is just kind of the 30,000 foot view scenario. Your imaginations can go wild. Building ADUs on a single, on a detached, attached, multiple rental properties. There's so much potential when it comes to using these things as a long-term cash flow strategy for yourselves, for your kids, your grandkids. As a real estate agent, when you're talking about long-term planning to really be a value add agent, just understanding how these loans work as a tool to either help clients age in place and stay in their wheelhouse as a long-term solution. Because eventually, hey, they could write into their estate plan and say, in my trust, that agent, Bob Smith gets to be the agent that sells my house when I die. They can do anything they want. So being the value add long-term and just staying on people's radars and having these kinds of solutions is really important, because it's going to increase your value to them and it's going to increase your book of business over time.
Yeah, and I think that it's just using your resources. I know I've said it a couple of times, but you just kind of think of Jeremy and his people as a resource to be able to kind of look at and examine, identify that whether they have, as in this sort of a slide, he's showing, there's a primary residence with one attached ADU, one detached, one attached, or you have different sort of scenarios where you're going to be able to use that equity. And even though that there's like 6 illustrations here, there are hundreds of different sort of situations where being able to access the equity is going to, come into play. And as he said, you're the value add real estate agent, you have a relationship with these people, and you're going to be the trusted source.
Absolutely. Yeah. And having some real kind of meat on the bone when you reach out to these folks, not just, hey, I'm still your agent, or hey, I'm still your neighborhood guy, but to actually provide some real information to say, hey, here's a strategy. I was thinking about you. Have you thought about this? Hey, you're in the 2-story. I noticed it was kind of hard for you to walk up the steps or, walk down the steps when I rang the doorbell. Have you thought about this? It just creates so many opportunities and openings for you as an agent to present this as a solution. And when you can speak about this with authority and you can calm people down, because usually the first reaction you get is, oh, I don't want to talk about those things. Those things are bad. Well, now at this point, you guys have been listening for almost an hour and a half, and I hope I've shown you that these things are not bad. These things are absolutely incredible, and they're really geared to protect consumers. So when you can say that and they go, oh, really? Well, if you're a trusted source and you're saying this, maybe I'll listen to them. So
yeah, no, absolutely. Was this the last slide?
It was. Yep. So if you have questions, email me, call me. I put my direct contact info into the chat. Otherwise, that's our web address. You can go on there and just grab the contact form and fill it out.
Yeah. So if you're still with us and you want to do a screenshot of this one, because it has all the Golden Age financial information, you can reach them at a toll-free number of 866-407-4247. And the website is also www.goldenaf.com. And I do recommend that you reach out and talk to them. If you would end screen share, it is going to be time for the Q&A that I've been waiting for.
All right.
For an hour and 34 minutes. Thank you for that. Absolutely fantastic.
Thank you.
One of the things that I want to kind of bring up in my research and my notes, can you talk about loan proceeds? So the loan proceeds from a reverse mortgage, are those taxable or non-taxable?
Good question. Nope, they are non-taxable because it's a loan. It's not considered income. And
so that's something else to kind of think, because folks that are in this may be in this situation are highly sensitive to what their tax obligations are, because they are with a lot of detail trying to get all those numbers to balance, because if they're on a fixed income, every dollar matters. And I think that's important to keep in mind.
Can I touch on that for just another second? Just something to think about. So when it comes to that, because of tax purposes, this is a really important tool to understand. So I had a client, they had a 2-story house. They were in El Cajon. They wanted to move out to Ramona. And so this guy
I lived in El Cajon. I know Ramona.
Okay. Right. So
it's like anyway, I'm not going to say, go ahead.
So they had a 2-story home in El Cajon, beautiful area, beautiful neighborhood, but it's a 2-story home and they just didn't need it. It was down to just him and his wife. He had pushing $1 million in assets, but his burn rate was astronomical because of his lifestyle and his home and the carrying costs and utilities and all this stuff, right? So they wanted to go out to Ramona and they wanted to use some of the proceeds of the home sale to do a reverse purchase So they were only bringing in the lowest amount that they could possibly bring in to get the loan done, right? Obviously, it's not going to be dollar for dollar. But it stopped his burn rate on his draw from his retirement account. And so with certain retirement accounts, and again, I'm not a tax attorney or a CPA, just understand that. But certain retirement accounts, the proceeds from them are taxable and others are non-taxable. And so because he got to stop drawing those things out, that got allow him to leave that money to grow. So there's more money to grow. And it happened to be right before the stock market just exploded. So he ended up having a ton more money to sit in there, not having to draw out $8,000 a month or whatever he had to pull out. So his retirement account actually grew exponentially because he didn't have to keep pulling that money out to make a mortgage payment. So he was just like, he called me laughing all the time. He's like, I can't believe how much freaking money I saved doing this.
And that's good. That's good for him.
Yeah.
I'm happy to hear that.
Yeah.
So there are some of the tough things about reverse mortgages. So I want to kind of go into those a little bit. Is that the reverse mortgage does have origination costs, which are called upfront fees, and there's also closing costs, and there is, there's mortgage insurance premiums, and there's interest rates. One of the questions that somebody asked, and I didn't bring it up, because I knew I was going to ask the question myself, is there a general interest rate, and how does that relate to prime?
So it's not related to prime. So there's different product types. The 30,000 foot view is there's fixed products. The difference between the fixed and the adjustable stuff is the fixed products are lump sums. So you don't get the line of credit, you don't get the growth rate, and it's literally a take it or leave it. You say you qualify for, again, I'm just gonna use the number 30%. So it's more than that, but just easy math, right? You qualify for 30% of whatever your home's value is appraised at. And, let's say that number is 300 grand. And you say, I don't want 300 grand right now. I don't want to pay interest on that. I only want 100 today. Well, if you only take 100 that day, the remainder goes away. It's still in the form of equity, but you lose the accessibility if you take a fixed rate lump sum.
HELOC. I mean, a home equity line. I mean, a reverse mortgage. Sorry.
A reverse mortgage, correct. Now,
so you're talking about a product that is not a line of credit reverse mortgage. It is a lump sum. And the reason for that is it a lower interest rate?
It's a fixed rate. Those rates are, in fact, a little bit better than conventional 30-year fixed rates. They're actually lower. So when someone's saying, oh, I'm going to go get a 30-year fixed mortgage today and I'm going to get cash, it makes actually more sense to have the flexibility with making the payment or not to take out a reverse mortgage to access that money because the rate is actually lower and it's a fixed rate. Now, when someone says, hey, I've got and those kinds of situations really vary situation to situation, because what happens is you have different accessibility levels, whether you choose the fixed option or the adjustable option.
Is most common the adjustable? Is that what I'm hearing?
Yes. The most common product is the adjustable, and that's because that is what the line of credit is attached to. Okay.
So in a let's say they had to go borrow $200,000 if they could for a reverse mortgage. They then use, and this the adjustable rate because it's a line of credit, which is, I think if you're going to be doing an ADU, that's what you might want to think about. Maybe a better, but that interest rate on the amount that you've drawn out could fluctuate.
Correct. Yep.
Okay. And I thank you for that. The other part that I wanted to kind of touch on as well too is, have you seen where people have pulled out the money to do an ADU and they're using that rental income to pay back the cost of the ADU?
Absolutely.
Yep. Okay. And if you could just kind of, because I know you've been doing a brilliant job talking about all the scenarios, but can you talk about that, about that example?
Yeah. So I guess let's get specific. Do you have something in mind that you'd like me to kind of walk through? Or
yeah. So let's say it's 200. Let's say they could pull out 200,000. They had the ability to do it. And they put the 200,000 into an ADU, and they were able to rent it out for $3,000 a month.
Okay.
And at some point, and they said, hey, I just want to, I can't get all I can't access the money any other way than to get a reverse. I want to build it, but then I want to pay down that amount of the reverse. They have that option to be able to do it or pay it off.
Absolutely. So So let's say, so right now the adjustable stuff, the rates are in the low sixes, which is still lower than the traditional stuff. The fixed stuff is in the mid sixes, which is still lower than the traditional stuff right now. So let's say, just for easy math, it was 6.5% they borrowed on 200 grand, right? You're talking about $13,000 annually in interest, right? On that. So they're going to pay just over $1,100 a month, right? In interest. So if they pay that $1,100 that month, the balance does not grow. So if they're paying, let's say they take all 2,000 of that rental income and pay it directly to the loan, they're actually paying the loan down by
Right. By 2,000 a month.
By $900 a month. Because remember, they still have to cover the interest.
Right.
Right. So they're paying that loan balance down. So they could say, you know what, I want to pay this thing down for the next 5 years, because ultimately what I want to do is I want to refinance it into a traditional mortgage so that my kids can take over the house and not have to worry about anything, and they could just live here or rent here or whatever they do. Right. But that gives you flexibility. So let's say you're doing that, you're paying 2,000, 2,000, 2,000, 2,000. Oh, shoot, I need a new water heater.
Right.
There's $2,000, maybe 3 or more, depending on where you're getting it from. So maybe that month you don't pay anything on the loan, right? You pay for your water heater or your new transmission or whatever it is. And then the next month you start doing it again and again and again. In fact, that exact scenario is the scenario that a lot of, when I talk to married couples, we're going to pay this thing down, 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 so that if something happens to one of us sooner than the other, then we're going to let it reverse. As soon as we lose one of the incomes, that's when we're just going to stop paying the payment entirely. And then that's what happens.
Start accessing it. Thank you for that. Another kind of thing that I wanted to ask about is when you have a reverse HICM mortgage, does that affect anybody's government benefits? I mean, are they looking at the loan proceeds? I know they are not considered income, but would they affect someone's ability or eligibility for a needs-based government benefit, such as Medicaid or SSI?
So Social Security, no, because it is not considered income. Medicare, no, because it is not considered income. Medicaid is an asset-based government benefit. So I want to say the number is like 2,000. I don't think you get more than $2,000 in total assets. So
it's a very small number.
It blew me away. Like, this is kind of just a sad thing for me to hear as a human being. That someone,
I personally had experienced it with my mother who had Alzheimer's, and we had to spend down her assets, and it was a very, very involved process, and I don't wish that on anybody.
Yeah,
so that
and
she could qualify.
Yep, they lump in cars, what you have in the checking account. I mean, anything that you have. You can have a house, but you can't have more. Your checking account goes over like $2,000, and they're like, "Oh, you just lost your Medicaid benefits." Like, how is that? I mean, that's just, it's not even fair. I don't even know how to put it any other way. It's just not fair. So yeah, so when it comes to this kind of thing, so let's say somebody was a spouse, a surviving spouse, and they ended up with $600 in Social Security. Very, very low number, but I've seen it plenty of times. So that Social Security check comes in every month. They could actually structure the line of credit so that they only draw whatever they need to stay under that threshold. And then it wouldn't affect them, right? They can't go draw out 10 grand and stick it in the bank and go, hey, I'm going to go help everybody. But they could draw, several $100s a month, just as long as they're spending it and it doesn't accumulate over that number.
Yes. And again, there are ways to be able to look at these things. And if anything, for the hour and 45 minutes that we've been doing this conversation about reversed HICM mortgages, if anything, these are complex, sophisticated products, but they have a very fundamental benefit to people that cannot qualify for any other sort of source of income, and they're able to tap into the equity if they need it and if they want it, and they can use it. And for everybody who is still here, and we've been staying strong numbers here. So thank you, everybody. And if you're listening to this too, I know it's a lot of information. Reach out to Jeremy, call the 866 phone number. We'll definitely make sure that we drop it into whether it's on our podcast or whether it's on the ADU University or wherever we're going to sort of feature this. Is that I want you to feel that you don't need to understand it. They're the professionals. They'll help you. Every situation is different. They'll help you. So if you are reaching out to your client and they're like, I just need to have some money, and you know that they have some equity, just throw this out to them and let them explain it. And having been here for this long, you know that there are places and situations where this is probably one of the best things for somebody, and it is a great resource, and it's going to make you as a real estate professional or an ADU provider be that much more knowledgeable to be able to kind of fit a particular need. Is there anything, I know that we yes, Carolina, thank you for that question. I will share that video with you. And then if you're listening to this on the podcast, you have to be a subscriber to the ADU University, which we're building out. And you're welcome. So that we're going to be able to offer these resources to people, because these are all tools that folks need to know. So in anything that you can kind of offer, Jeremy, I'll let you wrap it up.
Yeah, you made me realize I did not even cover the most basic fundamental thing about this, and that's how to qualify. And this is the stuff that usually I feel so silly. And this is so critical for agents too, because everyone says, oh, what can you qualify for? These are not like conventional loans at all. They don't do debt ratios. They don't do credit scores. They don't do that. So you can have a client on Social Security, and we have to do what's called a residual income test. And a single person needs $580, and a married couple needs $980. Just as long as there's that number remaining after all their other expenses are paid, they're going to qualify for this loan. So you can you can sell their current existing primary residence and go take the proceeds and put it as a down payment on a new home. And they don't have a debt ratio issue, because there's no such thing as debt ratios for reverse mortgages. In fact, for investors, this is huge, because the reverse mortgage doesn't even show up on the credit report. So when you're talking about doing debt ratio qualification, if you've got other investment properties, you could build an ADU on your other investment property. And then if you've got, like, you could do a DSCR loan on that thing, and now you've got increased cash flow from that rental property and an increased value. So if you're trying to pull equity out of that property, that's a really slick way to do that. Because
I have no idea. I had no idea it didn't show up on your credit reports.
Doesn't show up on your credit report. Because there's nothing to report. There's no monthly payment. So you can't be 30 days or 60 or 90 days late. There's no such thing as being late with a reverse mortgage, because there isn't a required payment.
But they do need to be able to take care of the property taxes. Mm-hmm. And what else?
Homeowners insurance. Yep. There's three things: primary residence, pay the property taxes, pay the homeowners insurance. And then those are two together. And then the last one is maintain the property. So don't let the home fall into disrepair, cracked windows, chipped paint, peeling paint, and then just don't let the front yard turn into a junkyard, and you're good.
Excellent. Well, I really appreciate this opportunity to have a conversation with you, Jeremy. It has been very educational. And for you to take all of this time, because I know you're busy, you're very popular. I know you were a featured presenter in San Diego at an ADU gathering of real estate professionals. So I know that your time is limited. So thank you. And to everybody that's here that joined us live for this, thank you again for your time. Really appreciate it. And for the folks that are listening into this, if you have any questions, just reach out to either Jeremy or myself. We want to help you build an ADU. We want you to figure out what's best for you. We have your interest at heart. And we also, everybody here at the ADU University, we want to help educate you on all the options that are out there. Jeremy, thank you to Denise, who I think is still with us. It's wonderful for your help in putting this together. And everybody have a fantastic day.
Thanks so much. You as well, Dave. Appreciate your time.
Yeah, you're welcome. Take care. Bye-bye.
Bye.